Hello, folks. Welcome to Market Trends. I'm David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. As usual, we'll start off with a few disclosures and very interesting conditions we have now. We have essentially a degree of equilibrium in terms of interest rates that could set up an interesting risk-on environment. A lot of fears are kind of potentially now you could say fading. We also see standardized returns of some of these ETFs that we'll mention, but it's an interesting sort of environment. And I think one of the things that really does stand out to me is the kind of broadening away from companies like Microsoft, which did not have the most impressive earnings, and it's going to some interesting other directions. So these are the standardized returns. Now, wanted to also remind you guys go to tradestation.com, go to Insights, and then on the Insights page you will see this blog post. Goodbye Fed, hello earnings. Speaking of earnings, well, actually, first, if you look here at this blog post, you will see that we have this zip file, and in the zip file, it has a series of ELDs and workspaces, and one of these is the ones that I used right here, the MT main. The last version I did was in October, so it's called MT main October 2024. If you go here to the earnings dates, you can go to data and then bring in, for example, the Nasdaq 100. So I want to remind you guys that it's a big bunch of earnings coming now. Next week we have I think about a quarter of the S&P 500 are reporting next week, and just a lot of names coming. And of course, we have Apple this afternoon. So if you want to be able to prepare and plan for earnings season, these are some of the ways to do it. I'm going to actually jumping back to this a little bit after, but I wanted to first go over to a few other things. And I wanted to start off with our key ETFs because there's some interesting things happening over here with our key ETFs. Actually, let me also share some important links in the chat if you want to view our disclosures page or anything like that. You can see the chat. All right, now here's what jumps out to me. It's kind of interesting. We can see here the 21-day return, which is 1 month return. Gold miners been doing well, and that's pretty interesting. But also look at the Chinese stocks and the Brazilian stocks. So from my view here, we have to take a step back and look over here at our 10-year treasury yield. And we essentially see, as we've mentioned, that we had a false breakout above the April high. We were not able to really get above 4.75. Now we're down at 4.5. And essentially, the Fed yesterday did nothing as expected. And I think that Jerome Powell basically was just didn't want to say anything. And that's not to be a surprise. The Fed has a lot of other stuff coming up. They're going to have more payroll reports. The Fed meeting, the next Fed meeting is late in March, and they're going to have more payroll reports. And also, I think just remember, Jerome Powell is going to testify in Congress sometime in February. That has not yet been announced, but that could actually be the event if we want to actually get more of a direction of rates and things like that. So some point in February, by that point, Trump would have done some tariffs, so have some idea of fiscal things, and that's when things could start kind of coming together. So at this point, we kind of have the Fed fading as an overall catalyst. Yields did not break out to the upside. We have jobs next week. But again, I think at this point, we kind of know where we are. GDP today was kind of soft. And I think overall, there's an environment where we've now reached a kind of point of equilibrium where, rates may have stopped moving. The other thing that's important is the dollar index. Dollar index here has, also kind of, it's trying to hold, you could say, trying to hold above this level or something here. But in my view, the bigger thing that matters here is that we were not able to really get up toward these highs, and there's nothing here that really gives a clear sense that we're going to see a lot more dollar strength. There's, since here again, the it's now just kind of lost its move. This trend here could just turn into nothingness. And if we basically see the dollar be kind of stable or weaken, that is also a potentially positive environment. So I think the thing that really stands out to me here is that we are seeing the arrival of some weak dollar trades. And I think that's interesting for some various reasons. For example, um, weak dollar has not been a particularly good trade for a long time. And we also have the fact that China is kind of doing some interesting things here. So one of the things we have in our rundown today that I want to mention is it basically, you know, when I was back at Bloomberg News many years ago, and we had an editor, and he would say, when you're a news reporter, you're writing the first draft of history. Well, I have to say that if I actually was going to think as a big picture here, think of January 2025. We basically had a stream of news that last week we documented on Apple and how Apple was losing market share to these Chinese brands, and we talked about that. But that's pretty significant. Then almost immediately after, DeepSeek comes out and like freaks out everybody. So I'm not saying that the U.S. is falling behind China or anything like that, but this could be a month that we look back on and kind of say historically, this actually is something of a turning point, or maybe not a turning point, but it's a milestone in certain things happening in the world of tech and everything else. Now, who cares about that overall when you really think about it? I mean, it's academic, but from an investing perspective, a trading perspective, it might be interesting because what do we have now? We basically have Chinese tech doing well. We have American big cap names that everyone over owns not doing as well. Then we also have things like the Fed essentially kind of reaching a degree of not wanting to hike anymore and maybe leaning toward the rates going the other way. And we also have Trump doing what? Well, not raising tariffs really aggressively the way he has. And it looks, when you look overall at what he's doing right now, doesn't seem like he wants to be getting in trade wars. It looks like right now he's doing internal stuff in the government. He's doing all this stuff with, with the aid programs and with different personnel and all this stuff that you can see, but he's not going after the trade issues now. So I think it's interesting to kind of see that, because if you were to think about it now, we could be in a spot where maybe the Fed's done hiking, maybe the dollar is weakening, maybe Trump is not going to wreck China. There's a lot of fear that he was. And at the same time, China is doing things with these smartphones that are doing well, and DeepSeek. These companies trade at much lower multiples than American companies. Maybe people start to say now, you know what? Maybe this is actually a spot where when you look at China, look at the FXI, for example, on a weekly, I'm just going to look at this one on a weekly chart, FXI on the weekly. I mean, this has basically gone nowhere for a long time. And, I think this is just something to kind of have an idea about, because with the dollar weakening, and we're seeing that with gold, we're seeing it. A lot of European stocks are actually starting to outperform as well, which is kind of interesting, despite Europe being in a complete economic, just crisis. Not a crisis, but really not looking good economically. Something's interesting is happening here. And when you think about the market, kind of goes through cycles of large cap growth when people focus on those names, and then it kind of goes to the everything else trade. And I'm seeing right now, as I'm seeing things like utilities. Let's take a look over here. We look on a kind of 5-day, or maybe not 5-day, but the one thing that's standing out to me was that utilities outperforming. REITs, I don't know where we have REITs. On another one of my lists, REITs, here you can see here, Real Estate Investment Trust. I'm sorry. Look here, you can see today, utilities, real estate investment trusts are doing really well. China's doing well. Gold miners are doing well. Banks are doing well. Home builders are doing well. That is sending a message that the market has a sense of rates. Oh, I'm sorry. Let me actually hide myself again. It's actually showing us here that we have more of an expectation now of rates having peaked. And that creates a different kind of market. And I think we just have to realize that kind of market of rates coming down, a broadening market, weak dollar market, that is not as favorable for the mega caps, and it is more favorable for smaller other sorts of things. I'm going to get to some of those. All right, so I got to also flip over to the S&P here. As you can see, we have this kind of breakdown of this chart, and some of the things to me that are in this that I wanted to mention. First of all, that I think is pretty interesting is this is my kind of ongoing chart for this webinar. But it's really interesting to me was we held that 50% retracement. And we also have a level. There's all kinds of strange levels. We talked about 59.33, which was pretty key on this day back here on the 16th, which was, I think that was one of our the 16th of the webinar. And we said if we hold that level, it kept the direction, in a positive way, and basically it held, and the next day it continued higher. But now here we have this other level, and there's a level I drew on my chart way back in the first half of December on a different chart, and then I kind of came back to it, and I realized that this has been an important sort of area, because it was basically where we failed back there right around Christmas time. And then basically now we're back above it. So if you look at this level here, which is right around 60.32 on the S&P here. You can see it was resistance, and now we're kind of testing it and turning it into support. So we hold a 50% retracement of this move. We go Friday to the high, and then we have that 50% retracement. We have the 50-day moving average. We have the 21-day exponential moving average. This is a significant sort of thrust. And I think right here, when you look at that rally and holding 50%, this market has essentially been going nowhere, as we've said, really since the middle of October. There's been a lot of ups and downs and stuff with the election and everything else, but we're setting up potentially here for a spot where, if we escape from this consolidation range and we get back above 6,100 and stay there could be an argument for an extension. And I think that's really what we want to be thinking about as we look toward earnings and everything else coming. And part of the reason for saying that is the fact that, look at what happened at other times when it really breaks out. It tends to extend. And I think that's the key thing. If you look back here, I mean, it does it different ways, but once it kind of clears the new highs, that was also I don't have it on this chart, but basically, if you go back to early, the breakout was right around 48.18, beginning of last year, and it extended. So, I mean, if you look back, these extensions have historically, 5% extension after a breakout to new highs has been, not out of the ordinary, for the last 18 months. So I think right here, if we clear 6,100, people might be thinking that we're in a spot where things can kind of extend. And I think also the thing is like I said, with the idea of rates having peaked, and also the idea of Trump not starting trade wars and not doing anything too aggressive at this moment in time, it creates an environment where there's a lot of fear, a lot of cash on the sidelines, and that potential for that sort of, kind of wall of worry to come into effect. And that's kind of what I'm seeing here. So we have this gap from Monday that remains in effect. But from my perspective here, we have the short-term momentum having turned up. It's also interesting that RSI has not gone overbought for a while, never went oversold, which in my book is actually pretty interesting, because going oversold can be. I like RSI in the daily chart of the S&P to basically give me direction. So what I've noticed here is that when it goes overbought, what it means, it doesn't mean to be bearish. It means to basically be bullish a few weeks later. It goes overbought, and yeah, that you don't chase that, but then it actually tells you we're still in a spot where the momentum is bullish. And essentially here we went overbought, we didn't hold it, but the key thing is that since then we didn't go oversold. So bear markets in the S&P have kind of they begin with RSI going negative, going oversold, and then kind of from there the bounce is not as you get a bounce and then it's not as strong and then it turns weak. So I think that's the key thing here, is that nothing here is giving me much of a sense of this, having that sort of downside. It has more of a sense here of us having a period of consolidation with the potential for resolution to the upside. So this kind of environment, we have our volatility cycle. Actually, I don't have it right in front of me now, but the idea is that we're getting to this spot when things get volatile, things get crazy, and everything correlates together, and then it actually comes back to a spot. Here, I actually have it right here. I'll show you. So this is, but my point is here we're in a spot where we've already had the correlated rebound, and now we're in the spot when volatility is falling, and we're getting in this spot of less correlation. So I think the thing is, we talked about on Monday when the market snapped back, and we had kind of identified, that the big indexes were the place that would have the bounce, and it happened. But now what do we have? Now we see things like small caps starting to outperform. We see things like a lot of small individual names outperforming. So that's kind of, we're entering that period now of looking for individual areas, looking for smaller sort of stocks that might do things, and I think that's the kind of the way this cycle works. So in this environment, there's going to be potentially more talk about things like M&A and stuff like that, and we could see the VIX make a nice steady grind to the downside. At this point, I think the VIX. We've been through everything here. Where I think if you look at this thing historically, this was COVID. And if you think about it, I think you can argue now, maybe not totally, but the mess created by COVID of the recession and then the inflation and then everything else, it's finally like subsiding. And the thing is that the market, when it gets into something positive, can the VIX can go under 10. It can go down to 8 or 9. And that might be what we finally look for. And if that happens, we could have an environment here of this sort of like money just coming off the sidelines and the wall of worry. So I'm kind of at the spot here where to when I look at this kind of condition, that we might see more of a sort of complacent, giddy melt to the upside. And one of the reasons I say that, and I point back to 2 or 3 weeks ago when we had that massive flip on the AAII sentiment that we actually highlighted at the time. It was a big flip, and things seem to be melting in that direction. So that's kind of where I think is what I was pointing out. Now, today, the European Central Bank cut interest rates, and they said a bunch of negative stuff about their economy. Nonetheless, the euro continues to move to do kind of okay. It's we've seen things like gold and silver perform well, and so I think that also tells me something here. It doesn't tell me that, or it doesn't tell the market, I should say, that the euro is going to crash. What it tells the market is that the Fed doesn't, that central banks are done hiking, and it kind of confirms that the global central banking community is walking in a dovish direction. When Lagarde says these things, then the German government yesterday cut its GDP estimate. So I think overall this actually bolsters the overall dovish sort of direction of travel that we've been seeing. Today's GDP was actually very interesting because what it did was it had strong consumer spending, and at the same time the initial jobless claims were lower than expected. Continuing claims continue to improve, or not improve, but they're not making new highs. And that was one of my big fears a few months ago, that we were going to see this like structural unemployment, the labor market was going to fall apart. And I have been kind of concerned by the overabundance of healthcare jobs, and not the manufacturing, not the construction and stuff. But it is not translating into the kind of worst case scenario that I was afraid of, which was going to be more of a recessionary environment. So we're at a spot here where we could actually see the consumer start to kick back in. And if rates come down and we get some activity and relief in the housing market, then that also can be a significant boost on the consumer side. So this economy could simply shift back to a consumption economy and less of this sort of capex economy that it had been. And that also could be something that is a different kind of market than we've seen for a while. So to me, these things are all kind of pointing in that direction of the fear having eased, and essentially things from here kind of being steady. With, you don't want to ever predict things are going to get better, but the market has been through a spot where a lot of bad stuff has happened. There's a lot of cash on the sidelines. Remember, earnings are supposed to grow double digit this quarter and the next 2 quarters. So the thing is, when you're in that environment, if you have to err on the side of being a bull or a bear and you have a ton of cash, where do people go? And I think that's really the spot a lot of people are going to find themselves in right now. Now, over on Market Insights, we had some other things that I wanted to point out that I thought were kind of interesting. We had some option stories. Someone was buying a call spread in Micron, and someone was selling a vertical call spread as a credit spread in Super Micro. You might want to check those articles out. It's kind of interesting. You know what? Let me fire up my Option Station Pro, because I want to show you some stuff on the options chains. Now I'm going to just quickly show a few other things that kind of fit into that potential. And to me, I'm always looking at the mid cap index. To me, this is interesting when we see how it basically jumps and holds. The MID also has gone nowhere. It has a lot of industrials. It has a lot of financials. Look at the Russell. This was something, you look on the daily, it was struggling, but now this is something that this might turn into, a bullish flag. And, you can draw it a few different ways. I mean, I just think we have to realize here is that there's this sideways movement. And when you look at this sort of pattern overall, the fact that it basically held, didn't really retrace any of this. This is to me now leaning more in the direction of the Russell and the mid cap. This is the daily now of the mid cap, essentially having, a tight consolidation. I mean, I'm not sure exactly how to draw these, I'll be honest. But when you look at these, I mean, this is in a spot where I think we can kind of, people looking for this short continuation, it does potentially fit into this thesis of what we're saying here, of the money shifting away. Now, if you look over here, on our Breadth. MT Breadth is one of our workspaces we share with you guys as well. MT Breadth also shows, for example, actually, I hadn't even looked at the advanced decline line today. Look how nicely the advanced decline line is pushing higher. Today's advanced decline line is 5-1. It still is not the high it was in November, but it's interesting. Look over here on the actual radar screen here. Excuse me. You can see that the 21-day, the RSP is outperforming. The RSP is equal weighted. It's outperforming in the today. It's outperforming in the last week. It's outperforming in the last 2 weeks. It's outperforming in the last month. So this all kind of fits in with what we're saying here. I think that's kind of interesting. You can also see in the last month, what is the only red sector in the last trailing 21 days? It is the energy, the technology XLK, energy and financials doing well. So financials to me also remain in a spot that are pretty interesting. Let's actually, I haven't looked at this one today, but if you can look at this on this chart, see, I mean, essentially, just a nice continuation. Didn't turn into a double top or anything like that. So this is like, I think it's pretty interesting to see XLF breaking out and XLK, well, going nowhere. This is kind of telling us here that I think that that's where the relative strength is. XLF outperforming would also be consistent with the mid cap doing well, with the small cap doing well, with the equal weighted doing well. That's the mid. Now, another stock that I've watched for a long time, and I mean for like decades, is wheat and precious metals. Now, we talked about silver. Let me just jump over. Remember silver? This is just a chart on TradingView. It's easier to see. But we had talked about this line on silver. And, I think this is like something here that, here we have the breakout of this falling trend line. We actually did a TradingView idea on it somewhere. Silver may be attempting a breakout. I'm going to go back and look at that one. But wheat and precious metals, this was like the most popular silver stock like 10, 15 years ago. Used to trade a lot of options. It had a different symbol back then. It had a different name. But regardless, look at this on a weekly long-term chart. Look at how it basically consolidated above its high from 2020 here. And this is just, I think, something interesting to kind of see here. This level around kind of 57, it held that. So this WPM to me was one that was kind of jumping out that was pretty interesting. I wanted to mention. Just want to put that on people's radar. Now, I mentioned what's happening in China. Let's look at Alibaba. Look at this here. Now, a name like Alibaba, let's go over here to my MT Main. Look at our chart on MT Main. Alibaba, of course, being a Chinese company. Now, what's interesting about this is that a person might kind of look and see, we do potentially have some space on this chart. It has jumped, but if a person was to look out through February, which is essentially like, 3 weeks from now, in terms of when the expiration is, we basically, a person could look out and see here a move toward 116, might be something that could happen. And if you look here at, I made this white so you can see it more easily. I hope it's not too bright for you. But anyway, we might go here and look at something like a person might kind of click on the 108 calls, click on the ask will generate potential buy order. And if you hold down control and then click on the 116, what it will do is it will basically create a vertical call spread there. So that spread of about $1.60, that's an $8 spread for the cost of about $1.68, something like that. It's almost a potential, if it goes that level, it'd be a little bit under 400% potential return. And again, we're in a spot now where I think China has been hated for so long. I mean, first you had Xi trash his own stock market, his own economy. Then you had Trump come out and beat up on them, and all these other things have happened. So I think we've gotten to a spot now where like China is just like a thing that so many people are not interested in. But then at the same time, you have Microsoft just having a dud of a quarter. And then Apple today expected to have kind of maybe a dud of a quarter. Now, again, there's so much negativity now toward Apple that, you don't want to necessarily, be too firm in anything here. But the thing is, when we look at it, there seems to be now that's interesting to see this relative strength happening in China. It's also a new year. Don't forget that, because sometimes things. Maybe it shouldn't make any sense, but it does. People say this is like, this is a new year. There's new things happening, and people have, new profit and losses, and they have just new positions. And I think this is something to think about here. But we could see, and often in the market, the contrary thing to what people expect is what actually happens. So everyone thinks Trump's going to come in, he's going to destroy China, and then maybe the surprise trade is that China outperforms. And don't forget, when Trump came into office before, Chinese stocks had a great run. So I think it's just something to think about here. And the last thing is just that they've been bad for a long time. And there's so Baba here, I wanted to point out. The other one is Baidu. I mean, Baidu's a stock. I mean, this was one, I can't believe this name is this. People forget completely about this stock. I mean, look at how this is just, I somewhere have it. I have a weekly here somewhere. I don't know. Here it is. I always have my weekly chart here as well that I can look back on. And again, this is something where, in some ways, the technicals on this, you know, it's more about the levels. I mean, the trend you can obviously say is bearish, but I mean, when you look at where we are now in terms of the short term sort of energy and the short term sort of attention, there's like, again, when something has been bad for so long like this, people don't get the bottom, and it's more a question of, here's something where it used to be such a strong name, and here it is holding, like, can you believe it's holding levels from like 2013? I mean, the 85. That's what we're seeing on the weekly. Anyway, go back over to Option Station Pro. A person also might kind of be thinking the same way, kind of thinking about February. And this one kind of jumped out to me, like the 100. So if you look at this stock, a level of like 100 up to 110. Can it jump up toward those levels through the end of February? So, a position like that, a person might click on that ask there on the 100 and go to the 110s, and that's basically about $1.92 for a $10 widespread. Which, if it does that, that would be, over 400% potential profit from the stock going up, you know, from 95 to 110, which is about 15-20%. So that's the way people might think about using options for leverage on some of these. Now, there were some other names that the options were not as obvious or, really jumped out to me, but I will just point out to you, JD. I mean, this chart is kind of interesting. I mean, it just kind of spikes, and it just, this tightness. I mean, tightness is usually a sign that there are not a lot of sellers. So JD here, another Chinese tech stock holding above 40. And then another thing here is VShop, VIPS, sorry, not VIP, but VIPS. Another name here, just kind of powering. See, look at how we have this high from December, and it's holding and potentially breaking it. This is a sort of price action when something is kind of bottomed. And it'd be nice to say, oh, I bought it at like 13. But the fact is that when you have a stock that's been struggling for a long time like this, people might be just looking up toward these highs from back in October and say maybe it goes back toward those kind of October highs, or, over 17, and targeting levels like that. So VIPS was another one jumped out to me. And another name is XPeng, XPEV, the electric vehicle stock. I mean, this also here has been, I mean, it's actually like hitting a 52-week high. I mean, it's pretty interesting. So this also want to kind of put on people's radar, having some interesting price action. Some other names that were jumping out that, we talked about Expedia, and we did a trading view idea on it. We talked about Expedia down here when it had those really strong earnings. And, the earnings on this one are on the 6th. It's been just like a complete funk of just, I've seen these things happen when a stock has been strong, and then it just kind of has this kind of sinking, and it's like just depressed, and it just sits there. And then sometimes, though, that's when a call spread into earnings might potentially have some potential. Now, the earnings are far enough away that trying to create that call spread now doesn't make sense. And people might want to be thinking about, when we get closer to that earnings date, looking for a spread that'll launch it above 190. Because all the indications are consistent when you look at other travel stocks, that this is just kind of a pullback. Now, I also want to mention next week I'm out. I'm not going to do state of the market or market trends. So we will be back with you guys on the, I think the 10th. So just so you realize that. So that's one reason I also wanted to give it to you now. Wells Fargo. All right. I'm going to run out of time to talk about Wells Fargo. All right. Look at this breaking out here. Now, this might be something when people look for a calendar spread in a name like this. The reason is because, based on trajectory, people might look for a name like this to just grind higher. So I'm going to actually reduce the number of strikes I look at. What a person might do is something like this: is they look at a month like they look at something like March and the next week of the 7th, right? Go to March monthlies. I'm going to have fewer strikes even. I want to focus on that 80 strike. A person potentially could buy the 80s expiring the March monthlies at 80, and they could sell the 80s expiring in 8 days on the 7th of February. Now, these have, look at the theta. These have 5 cents a day that they lose based on time value. These lose 3 cents a day. Now, that theta, if it stays below 80, is going to erode really quickly. So a strategy like this, a person, for example, could, if they were to do this strategy, they would recover about 20% of their outlay. They would recollect with the 47 cents. They do it every week going out into the future. They could essentially pay down the principal if the stock they pay down their actual cost if the stock stays where it is, but you can adjust it each month or each week that you roll it. So for example, a position like this, say the stock goes up to like 80 or 81 or something, these calls would still be worth more than the calls that the person is short. The thing is that these will lose time value more quickly. The other thing that a person can do is they can adjust it and turn it into a vertical spread. So say, for example, the stock closes at right around 80, and these calls are essentially worthless. A person can then turn around and sell like the March 85 calls, and the overall cost base will be lower. So I want to just mention right now, a name like Wells Fargo, very liquid, breaking out to highs, and it might be the sort of thing where people look for a calendar spread in a name like that. And then the last thing that I did want to point out was that, and I don't have the strategy on this, but a name like Meta could be something people look to sell puts on a pullback after its strong earnings. With probably not a significant, this is a breakout now, probably not a significant amount of pullback downside, given the fact we just had earnings and given the fact that it's essentially been consolidating here for several months. Then the other thing is Broadcom. This is kind of now staggering and injured. This might be something people sell strangles on when people essentially, you're essentially selling a credit spread above and below to essentially capture, income, and to look for the stock to go nowhere. This might be that kind of stock when you sell the call spread above and you sell the put spread below. Two together are called a strangle. But I want to just kind of point that out because this stock now could be in a spot when it's just kind of staggering and damaged, as people kind of look at the overall situation in chips and the Chinese thing and everything else. So I want to just kind of mention these sort of things jumping out, but the ones that really did jump out to me are the Chinese names and Wells Fargo. Those are some of the areas now where there are some interesting things that are now known and the patterns are in place. So hope everyone has a great week. On the week and a half for our state of the market on February 10th. Hope everyone has a great day, and I'll see you then.